What I'm about to talk about today could seriously change how you think about investing over the next 10 years, not just next week or next month, but the entire direction of where money may flow for a very long time. This is not a short-term story or a quick trade idea, but something much deeper that only shows up a few times in a lifetime. According to several well-known macro analysts who study history, currencies, and long economic cycles, we may already be entering one of those rare moments where the entire financial system starts to shift direction. These moments do not happen often, but when they do, they reshape wealth, markets, and opportunity for decades. If you've been watching precious metals recently, you already know how chaotic things have been. Gold, silver, and mining stocks have been all over the place, moving in ways that confuse and scare a lot of people. Silver jumped to levels that seemed impossible only months ago, and then suddenly fell nearly 30% in what felt like no time at all. Mining stocks have been even wilder, with daily moves of 15 or 20% that used to take months to happen. For most people, looking at charts every day, this kind of action looks dangerous, unstable, and completely unpredictable. To many traders, this kind of market behavior feels like a warning sign, something broken, something to stay far away from. It looks like the market has lost control and is being driven by emotion rather than logic. But here is the key idea that long-term investors need to understand, because this is where most people get it wrong. For investors who focus on big cycles that last decades instead of days, this chaos does not look like an ending. Instead, it looks like a reset, the kind of messy and painful price movement that often happens at the beginning of a brand new macro cycle. These early stages are almost always uncomfortable, confusing, and emotionally draining. That perspective is exactly what financial analyst Kevin Smith has been sharing in research that has spread quickly across the investing world. His argument is not complicated, but it is powerful when you step back and really think about it. He believes that the recent drop in gold, silver, and mining stocks is not the final chapter of this move, but the opening chapter of something much larger that could unfold over many years. At the center of his view is one simple but serious idea that deserves your attention. He believes the US dollar may be entering its third major devaluation cycle in the last 100 years. If that idea turns out to be correct, silver could become one of the most powerful investment themes of the entire decade. Before we go deeper, I want to pause for a moment and hear from you. Let me know where you are watching from, whether that is the United States, Canada, the United Kingdom, Europe, Asia, Africa, or anywhere else in the world. This community reaches far beyond one country, and I want to know who is here. Also, tell me your honest gut feeling right now. Do you believe the dollar is heading into a major period of devaluation? Yes or no? There is no right or wrong answer, and every opinion matters here. At Alex Carter Reports, transparency is important, so let me be very clear about something before we continue. This channel does not sell courses, signals, paid groups, or private memberships of any kind. The goal here is simple and straightforward: to share raw analysis, show both sides of every argument, and help you understand what is happening so you can make your own decisions with clear information. Many of you have reached out saying that this approach helps cut through the noise and removes the pressure of being sold something. That is exactly why this channel exists, and why this community continues to grow. If you want to stay connected beyond YouTube, the only official places are the WhatsApp group linked below and the account on X under the name Alex Carter Reports. Anyone else claiming to represent this channel should be blocked immediately. Scammers are everywhere, and protecting yourself is more important now than ever. With that said, let's get into the real substance of Kevin Smith's argument, because the historical framework he uses is extremely important. Smith looks at history not in short bursts, but across nearly a full century of market behavior. One of the most important tools he uses is a chart that compares gold to the S&P 500 over almost 100 years. This chart does something very simple but very revealing. It divides the price of gold by the level of the S&P 500, creating a ratio that shows whether gold or stocks are winning over time. When the ratio rises, gold is doing better than stocks. When the ratio falls, stocks are outperforming gold. On the surface, this sounds basic, but the deeper story is where things get interesting. When you zoom out and study this ratio over decades, you start to see that it does not move randomly. It follows long, powerful waves that reflect changes in confidence, policy, and currency strength. There are long stretches where stocks dominate and gold is ignored, and there are other long stretches where gold rises while stocks struggle. These periods do not happen because people suddenly decide they like gold. They happen because trust in the financial system and in paper money slowly starts to break down. Gold tends to perform well when people lose confidence in promises made by governments and institutions. Smith highlights two major periods in history where this pattern showed up in dramatic ways. The first took place during the Great Depression in the 1930s, a time marked by economic collapse and widespread bank failures. During that period, fear was everywhere. Unemployment was massive and confidence in the system was shattered. The U.S. government responded with actions that would be unthinkable today. Under President Franklin Roosevelt, Americans were forced to give up their gold, and private ownership of monetary gold was made illegal. After collecting the gold, the government officially devalued the dollar. The gold price was raised from $20.67 per ounce to $35 per ounce, which meant the dollar lost about 40% of its value overnight. Anyone holding dollars lost purchasing power. Anyone holding gold gained. This move helped the government deal with massive debt, but it came at the cost of the currency's value. The second major devaluation period began in 1971 when President Richard Nixon closed the gold window. This decision ended the Bretton Woods system that had guided global finance since World War II. Under that system, foreign governments could exchange dollars for gold at a fixed rate, which kept the dollar tied to something real. Once that link was broken, the dollar became a pure fiat currency. From that point on, money could be created far more easily, and the results showed up quickly. The 1970s were marked by high inflation and a massive rise in hard assets. Gold moved from $35 per ounce to over $800 by 1980, while silver surged from under $2 to nearly $50. Investors who understood what was happening early were rewarded in a big way. Smith believes we may now be approaching a third chapter that rhymes closely with those earlier periods, and that idea sets the stage for everything else we will discuss next. A lot of people hear this idea and immediately push back, saying that gold already had its big moment in the early 2000s, so this cannot possibly be the next major cycle. That question is fair, and Kevin Smith addresses it directly instead of avoiding it. Yes, gold did rise strongly from the early 2000s into the early 2010s, especially after the dot-com crash and the financial crisis of 2008. But according to Smith, that period was not a full reset of the system. Instead, it was more like a delay, a pause button pressed on a deeper problem that was never truly solved. When the system should have reset naturally, policymakers stepped in with extreme measures to keep it going. Interest rates were pushed down to near zero, something that had never been done on that scale before. The Federal Reserve began creating money electronically through a process called quantitative easing, buying trillions of dollars in bonds. This money kept asset prices afloat and prevented a full collapse, but it also allowed debt to keep growing instead of being cleared out. The underlying problems were postponed rather than fixed. Smith calls this period a false start because the conditions for a full devaluation were present, but the response stopped the cycle from completing. Instead of shrinking, the imbalances grew larger and more dangerous. To understand why this matters, it helps to look at the numbers and how much they have changed. In 2008, many people were shocked that U.S. national debt was approaching $10 trillion. At the time, that number felt enormous and unsustainable. Today, that same debt is over $36 trillion and still rising, with no real plan to slow it down. Back in 2008, the Federal Reserve's balance sheet was under $1 trillion. After years of crisis response, it expanded to more than $9 trillion at its peak. Each crisis has required larger and larger interventions to keep the system stable, and that pattern has not stopped. The cost of holding everything together keeps rising. Now the pressure is back again, but this time, the scale is much bigger than before. Government spending continues to exceed tax revenue by massive amounts every single year. The United States is currently running deficits of roughly $2 trillion annually, meaning it spends far more than it brings in. This gap has become normal, even though it would have been shocking just a decade ago. At the same time, interest rates have risen, and that has caused debt servicing costs to explode. The government now spends more money paying interest on debt than it does on national defense. That fact alone would have seemed impossible not long ago, yet here we are. This is one of the clearest signs that the system is under serious strain. On top of that, stock market valuations are stretched to levels that closely resemble past major market peaks. Large technology companies now dominate market indexes in a way that history shows is often unstable. A small group of massive companies is responsible for a huge portion of overall market gains. When markets become this concentrated, they tend to be fragile. Smith believes this combination of massive debt, rising interest costs, stretched valuations, and heavy concentration sets the stage for a major shift in where money flows. He argues that the false start of the 2000s only delayed what was already coming. The longer the delay, the more powerful the eventual adjustment becomes. This leads to an important question for anyone watching this closely. How many of you have been expecting something like this for years? How many people have watched debt climb higher and higher, knowing deep down that this path could not continue forever? How many have quietly prepared while others chased fast-moving trends? Some in this community have been thinking about these risks for decades, slowly positioning themselves and waiting. Others are just now starting to see how these pieces fit together. Both perspectives matter because every investor begins this journey at a different point in time. What matters most is understanding the forces at work right now. This brings us to silver, which is where Smith's analysis becomes especially interesting for those looking for bigger potential moves. Gold usually gets the spotlight when people talk about protecting wealth. Gold has history on its side, along with central bank support and widespread acceptance. It often leads the move when confidence in currency starts to fade. Silver, however, behaves very differently, and that difference is exactly what makes it powerful. Silver is more volatile, more emotional, and more sensitive to changes in demand. In the early stages of major cycles, silver often lags behind gold. Investors watch gold move first and begin to wonder if silver has lost its role. The gold-to-silver ratio stretches wider, and many people lose patience or doubt the trade entirely. Then, without much warning, silver snaps. When capital starts moving into hard assets in a serious way, silver tends to move much faster than gold. Its market is smaller and less liquid, which means it reacts more violently. There is simply not enough silver available at current prices when demand increases sharply. When buying pressure hits, prices jump quickly instead of rising slowly. This is why silver can fall 30% in a short time, and also why it can rise just as fast. The same forces that make it painful also make it powerful. Smith argues that the recent drop in silver is not proof that the idea has failed. Instead, he sees it as a normal correction after prices move too far, too fast. Strong markets do not move in straight lines, and even the biggest bull markets in history were filled with sharp pullbacks. During the 1970s, precious metals saw multiple corrections of 20 to 40%. Each of those drops felt devastating at the time, especially to traders using leverage or short time frames. But over the full decade, those pullbacks barely register on long-term charts. For investors who understood the larger cycle and had the patience to sit through volatility, those moments turned into major opportunities. If the dollar devaluation idea plays out over the next 10 years, silver's built-in leverage could make it one of the most dramatic expressions of that trend. You do not need complex strategies or borrowed money to feel that effect. You only need exposure and the ability to stay calm during extreme swings. That patience, however, is far more difficult than it sounds, especially when prices are falling and headlines are full of fear. The Great Rotation is the broader shift that helps explain why these changes feel slow at first and then suddenly become impossible to ignore. Kevin Smith uses this term to describe a long-term movement of money away from the assets that dominated the last 15 years and into areas that have been ignored for a very long time. For more than a decade, most capital has flowed into U.S. mega-cap technology stocks, large stock indexes, and assets priced in U.S. dollars. That strategy worked extremely well, which is why it became so crowded. Smith believes that era may be nearing exhaustion, not because technology suddenly becomes useless, but because prices, expectations, and concentration have become extreme. When too much money piles into the same place, future returns tend to shrink and risks quietly grow beneath the surface. This is often how major rotations begin, not with a crash, but with slow underperformance. According to this framework, capital does not disappear when it leaves one area. It simply moves somewhere else. The question is where it goes next. Smith argues that money may begin flowing into precious metals like gold and silver, into commodities and critical materials, into mining and resource stocks, and into foreign markets that have been undervalued compared to U.S. assets. This is not a story driven by retail traders or online hype. It is the kind of shift that large institutions make gradually, often without headlines or excitement. At first, it barely shows up in the data. A ratio starts to turn, relative strength changes, and small differences begin to compound over time. By the time everyone is talking about it, the biggest opportunities have already passed. That is how these cycles usually work. Smith's charts suggest that gold may already be starting to outperform stocks again, much like it did at the beginning of past devaluation cycles. The shift is subtle, but the direction matters. For silver investors, this is where the potential becomes much more dramatic. Historically, when gold starts to lead, silver eventually follows with far more force. Gold tends to move first because it is seen as stable and safe. Silver follows later, but when it does, the gains are often much larger in percentage terms. History gives us clear examples of this pattern. During the 1970s, gold rose from $35 to around $850, which was an enormous move by any standard. Silver, starting from a much lower base, rose from under $2 to nearly $50. Matching gold's multiple, but with far sharper swings along the way. The same thing happened during the 2001 to 2011 cycle. Gold moved from about $250 to $1,900, while silver jumped from roughly $4 to nearly $50. Silver outperformed gold in that cycle, but it was far more volatile, shaking out investors who were not prepared for extreme price movement. If this is truly the start of a third major cycle, the historical pattern suggests silver could once again deliver outsized gains compared to gold. That does not mean it will be easy or smooth. It means the ride could be uncomfortable, emotional, and filled with moments of doubt. At Alex Carter reports, it is important to show both sides of every argument, so now we need to talk about the reasons this thesis could fail or take far longer than expected. The first and most obvious risk is timing. Even if the idea is correct, markets do not move on anyone's schedule. The rotation Smith describes could take years to fully unfold, and during that time, prices could move sideways or fall sharply. Being early in markets often feels exactly the same as being wrong, especially when drawdowns last longer than expected. Another risk is the dollar itself. The US dollar has been declared finished many times before, yet it continues to dominate global trade and reserves. While its share of global reserves has declined, there is still no clear replacement ready to take its place. The euro has internal problems, and China's currency is tightly controlled. Digital assets remain too unstable for large-scale reserve use. Because of this, the dollar could remain stronger for longer than many expect. Silver also carries its own unique risks. Its volatility can damage portfolios if positions are too large. A 30% drop looks manageable on a chart, but it feels very different when it happens to your own money. Many investors discover their true risk tolerance only after prices fall and emotions take over. Another issue is correlation. There are times when gold and stocks rise together and times when they fall together. During moments of crisis, everything can sell off at once as investors rush for liquidity. We saw this in early 2020 when gold initially fell alongside stocks. Silver also has a significant industrial demand component. Roughly half of silver use comes from manufacturing and industry. If the global economy enters a deep recession, that demand could weaken, creating pressure on prices, even if investment demand remains strong. These are not minor concerns, and anyone thinking about this space needs to take them seriously. Smith's response to these points is grounded in long-term thinking. On timing, he argues that waiting for certainty usually means missing the opportunity. Early stages are always unclear and uncomfortable, which is why they offer the best risk-reward setups. On dollar dominance, he points to rising efforts by multiple countries to reduce reliance on the dollar, along with strong central bank gold buying. This process is slow, but the trend is moving in that direction. On volatility, he emphasizes position sizing and time horizon. Silver is not for everyone, and that is okay. Those who cannot handle large swings should reduce exposure or avoid it entirely. On correlation, he notes that while short-term sell-offs happen, hard assets have historically protected purchasing power over full cycles. On industrial demand, he highlights growing uses for silver in solar energy, electric vehicles, and advanced technology. These areas may help support demand even during economic slowdowns. So where does all of this leave us as investors trying to make sense of a complex and uncertain world? The dollar devaluation idea is compelling, but it is not guaranteed. History offers guidance, not promises. Debt levels, deficits, and market concentration suggest pressure is building, but policymakers have a long history of delaying outcomes. For those who find this framework convincing, the real question becomes how to position without taking unnecessary risk. That leads us to practical considerations around position size, time horizon, and emotional discipline, which is where many investors struggle the most. When everything is taken together, the most important part of this entire discussion is not predicting exact prices or calling perfect tops and bottoms, but understanding how to think clearly during periods of extreme uncertainty. That mindset matters far more than any single forecast. The dollar devaluation framework offers a way to organize what we are seeing in markets today, but it should never be treated as a guarantee. History shows patterns, not promises, and investors who survive long cycles respect that difference. If this thesis is correct, the path forward will almost certainly be messy. There will be sharp rallies that feel exciting and deep pullbacks that test patience and confidence. That is why position sizing matters so much. If an investment is large enough to cause panic during a drawdown, it is probably too large. It does not matter how high silver might go in the future if an investor is forced to sell at the worst possible moment because the position was emotionally or financially overwhelming. Sizing positions so that volatility can be endured is one of the most overlooked skills in investing, yet it is often the difference between success and failure. Time horizon is equally important. A long-term macro idea does not work on daily or weekly charts. Short-term price noise can completely drown out the bigger signal, making good ideas feel wrong at exactly the wrong time. Investors who approach this thesis with a multi-year view are far more likely to stay grounded when prices swing violently. Diversification within the theme also matters. Precious metals exposure does not have to mean only one asset. Physical metals, exchange-traded products, mining companies, and even gold alongside silver all behave differently under stress. Spreading exposure across multiple vehicles can reduce the risk of any single position causing damage during periods of volatility. Another key principle is humility. No analyst, no chart, and no model can see the future with certainty. Strong investors prepare for multiple outcomes rather than betting everything on a single scenario. That means acknowledging that the dollar could remain dominant longer than expected, or that policymakers could once again delay a full reset. It also means accepting that even a correct thesis can take longer to play out than patience allows. This is why emotional discipline matters so much. Watching prices drop by 20 or 30% is not easy, even when the long-term case remains intact. The recent silver crash is a perfect example of how difficult this environment can be. Commodities are now swinging like speculative assets, with sudden surges followed by violent drops that punish late buyers and leveraged traders. Smith argues that this kind of behavior is common in the early stages of new macro cycles. The beginning is rarely smooth or orderly. It is chaotic, emotionally exhausting, and often feels like the market is broken. Late buyers chase highs and get burned. Weak hands sell at the worst times. Leverage magnifies mistakes. Yet when these periods are viewed years later on long-term charts, the chaos shrinks into small movements within a much larger trend. What felt like disaster at the time often becomes barely visible in hindsight. The hard part is living through it without losing conviction or making emotional decisions. Conviction, however, must be based on understanding, not hope. Hope disappears quickly during drawdowns, while understanding provides the strength to stay patient. That understanding comes from studying history, recognizing patterns, and accepting uncertainty. No one knows if silver will become the trade of the decade. What can be said is that the idea is grounded in historical precedent, supported by current financial conditions, and taken seriously by experienced macro investors. The Great Rotation, described by Kevin Smith, is not something that will be announced loudly or celebrated early. It happens quietly, with money shifting slowly from one area to another while most people are focused elsewhere. Those who notice early benefit, those who notice late chase performance, those who never notice are left confused when results are obvious years later. At Alex Carter Reports, the goal is not to tell you what to buy or sell, but to help you think clearly and independently. The key takeaways from this analysis are simple but powerful. First, the world may be entering a third major dollar devaluation cycle, similar to those seen during the 1930s and the 1970s. Second, the rally in the 2000s may have been a delay rather than a resolution, allowing imbalances to grow even larger. Third, a long-term rotation of capital may be moving away from U.S. mega-cap stocks and dollar-based assets toward hard assets, commodities, and undervalued markets. Fourth, silver tends to lag early and then move violently, offering large upside potential alongside extreme volatility. Fifth, the recent silver correction fits the pattern of early cycle shakeouts, but also highlights the importance of proper risk management. Before closing, it is worth reflecting on how you personally handle volatility. Did the recent correction push you to panic, or were you able to stay calm and evaluate the situation rationally? These experiences reveal more about an investor than any chart ever could. If this discussion helped you see the macro picture more clearly, consider sharing it with someone who might benefit from a broader perspective. Subscribe to stay updated and join the community linked below if you want to continue the conversation in real time. Follow Alex Carter Reports on X for quick insights when markets move fast. Drop a comment with your thoughts. Do you believe a third dollar devaluation cycle is beginning, or do you think the system will once again be extended? There is no single correct answer, only informed perspectives. Always invest with logic, not emotion. Do your own research, understand both sides of every argument, have a plan, know your time horizon, and size positions responsibly. Do not follow anyone blindly, including this channel. The future is uncertain, but awareness and preparation matter. The precious metal space may remain chaotic for a while, but history suggests that chaos often comes before major shifts. How you think and position during this period could shape your financial outcomes for years to come. Stay alert, watch the data, think in long cycles instead of short-term noise, and I'll see you in the next update.